Welcome, everyone. I'm Dave Stoffaker, Senior Credit Trainer with Lenders Online Training. My colleague is Linda Keith, the founder of Lenders Online Training. Welcome, Linda.
Hello.
Today, we're going to be talking about non-operating losses, non-cash carryovers, and hopefully we're going to clear up some confusion about these NOLs. You know, net operating losses are confusing. Sometimes they can be very, very big. Sometimes we count them. Sometimes I think about, do we ignore them? And on the other hand, is there any hard and fast rule that I would use every single time? Today, we're actually going to cover on some areas. First of all, what are they? Second of all, what do we ignore? Do we actually ignore them? And when do we actually add something back? What is this, what I should say, non-cash item? How does it actually impact cash anyways? And what are the net operating losses? So how do they compare to other carryovers in a tax return? So first, what I actually want to do is maybe define the context a little bit. I mean, a net operating loss really is a loss from a business activity, a trade activity. So it's something that's really not absorbed into other income for that current year. So think of it this way, that we're actually not getting a tax break for the full loss at times because we can't. But instead of actually losing it, the IRS says, you know what, we can actually offset future taxable incomes for that. So they are what I would say carryover, or maybe sometimes you've heard the word carry forward. So I guess I actually want to touch on this a little bit. And this, I've learned this probably over the last year or so in the sense that net operating losses is the only phrase basically that does not use the word carryover. So it's kind of confusing, misleading. But we at Lenders Online Training, we always stress the fact that it is non-cash. It is although it does not have that carryover, what I say, clue, it's non-cash. So let's begin with, where do we actually find these things? Well, if we were doing a personal income tax analysis, a global coverage, we kind of look at the other income line. It's at the upper part of the return. And you'd find probably lottery winnings there. You may find other items there that might be kind of just in that bucket called other. They might be coming from a Schedule C, maybe a Schedule F, or they could be a pass-through from a 1065 or 1120S. Now, on the corporate side, the 1120, the corporate tax return, it's pretty straightforward. It's on the lower bottom of the form, basically on the first page. So it kind of stands right out. Mm-hmm. So think of it this way, that since net operating losses are a carryover, basically they are non-cash. So we don't want to actually include that in our cash flow calculation, do we? So do we actually ignore them or do we add them back? Well, here I go. It depends. Confusing, right? Let me clarify just a little bit. It depends on where we do our cash. Where do we begin that cash flow calculation? It's something like at times we use this for depreciation and other non-cash deductions. We add back non-cash expenses and to the number that we actually started with. Some of us may start at a different spot, but we always want to make sure if it impacts the number that we start with. For example, let's think of the personal income tax reform, the 1040. If your company guidelines are the adjusted gross income method where we're trying to take taxable income to cash flow, we actually we start maybe with the adjusted gross income. Now, if the net operating loss impacted that, which it most likely will because it's a before that, we're going to add it back. Now, on the contrary, if we do the schedule analysis method, we begin with a blank sheet. We start with a blank sheet, we build that up, and from that perspective, we leave it out. So in essence, we kind of disregard the net operating carryover. We don't count them. So the actual cash impact, let's think the checkbook, right? We actually not experienced that the prior year. Now, with regards to the corporate tax return, it's a little bit easier, but it still depends on where we go, where we begin. I like to prefer as it's towards the bottom, but I like to begin before the net operating loss, so I don't even worry about it. But some people will do it slightly afterward. Then we make the adjustment for it. So the bottom line, it's non-cash. So we know that we'll find it basically at where the bottom of the line is where we start our cash flow. So if you have a responsibility of maybe training someone on the job training, and that net operating loss is very large, maybe a junior analyst or myself, someone early on in the training when I first got into this, you kind of get a little bit nervous as to where we start with that. What do we actually do? So now that we actually talk firmly about the basic approach, Linda is going to talk a little bit about the advanced territory, going a little bit deeper.
Thank you, David, because in our Lenders Online training, we always start, because we have people coming in with less experience, we start with the basics. And as David said, NOLs are carryovers every time. Carryovers are non-cash every time. And we need to disregard the carryover either by adding it back if it's impacted our bottom line, or if we're going schedule analysis method and it hasn't hit our bottom line starting number yet, we get to leave it out. Those are the basics. And that's what everybody needs to understand. Now, you may be a person that is at the basics now, in which case what I'm about to say may or may not make sense to you because I'm going advanced. If you are, though, a more experienced person, you're the one that somebody's coming to you when they have this huge NOL and they're nervous about leaving it out, even though you've told them it is okay. Well, the advanced is this. Even though the NOL itself is a carryover, is a non-cash item referring to losses in prior periods, even though that's true, and therefore directly they don't affect cash flow, they do shelter other income from federal income taxes. Say that again. NOLs, especially those big ones, are sheltering other income from federal income taxes. So could they affect cash flow? Only and when they affect the amount these folks are paying for federal taxes. So this mostly comes into play with business and ag lenders who are going to subtract federal taxes as part of your cash flow calculation. And you actually need to decide whether the taxes in the tax return you're looking at are typical for them. So I'll talk to the people first who do subtract federal taxes. And then in a moment, I'm going to talk to those of you who do debt to income ratio and do not. So I'll cover it both directions. If you subtract federal income taxes and that NOL was really large but is now used up, what's going to happen next year to their taxes? Going to go up. How can you tell? You've got 3 years tax returns, 2 years tax returns. It's similar in amount. It will rarely be exact because we have to calculate every year how much they can use up. But if they have an NOL, they're required to have a schedule at the back of the tax return that tells you what year the NOL came from, what has been used up each year, and what remains. So I would suggest to you that if it is significant and therefore has reduced federal taxes because it has, you can go back to that NOL schedule. You can see how much is left. So you can decide, you know what, they've still got plenty. We'll stick with using the taxes they have. Or conversely, wow, they just used it up. So starting next year, we really got to bump those taxes up. And so this is the real advanced part, because I wouldn't expect a person who's new to this to remember all the what do you do, but somebody who is the subject matter expert at your financial institution who handles the difficult things should know how to do this. I just do a simplifying assumption. I take their tax divided by taxable income to get a kind of a guess as to their tax bracket, and then multiply that times the NOL that they're now losing and bump the taxes up for that. So you could do that as a kind of a quick and dirty calculation of what might happen now that the NOL is gone. As long as I'm looking at that schedule, though, I'm interested in a couple more things. If I'm a business or an ag lender, I'd like to know how old is that NOL? How long ago? The longer ago it is, the less I'm interested. But if it happened significant, happened right before the first tax year I'm looking at, I might be interested in, gee, what went wrong? Was this pandemic? Was this tariffs in ag? What happened here? Was it weather events? Why did they have such a big problem, and have they solved for that? Or you even could see in this NOL schedule that every 2 or 3 years they have big losses, in which case maybe they're a more volatile business than you understood initially. So we kind of have two things here. One is, what do we do with the cash flow calculation, but also how do we better understand this business. And particularly with those of you doing business and ag lending, you clearly need to understand that. So that's those of you who subtract federal taxes. What about consumer and mortgage lenders that use a debt to income ratio approach? Debt to income ratio doesn't subtract federal taxes. It makes a simplifying assumption that we all pay the same amount of taxes roughly given the income that we have. So as an example, 40% debt to income means that the 40% is used up for debt. That leaves 60% for taxes, family living, etc. But what if somebody is not paying as much taxes? What if they have a huge NOL that is sheltering other income from federal taxes? Well, then they could maybe have a debt to income ratio that's a little high. You're looking for compensating factors, and you realize, wait a minute, these guys don't pay taxes on all of their income because of this NOL. So maybe it's a compensating factor for you. Maybe you also go back to that NOL schedule to make sure that it's continuing. So it really can cause a calculation in cash flow, but not the NOL itself. It's actually the taxes that are impacted. As you can see, that's a little more complicated. I probably would not, in fact, in our lenders online training that we do, we actually don't give that second explanation to new students. You know, we're just going too far, right, David? It's like, don't do this to them. But somebody needs to know.
Yes.
Now, today, just today, in our virtual training where we work through case studies with our students in lenders online training, today we had an individual from a bank. They do both DTI and debt coverage ratio. I says, wow, well, you can't do both of them without doing something different with the income taxes, right? So we had to talk about, and also even grossing up non-tax, which I know I'm going off topic. So for those of you who can follow me, fine. If I've just gone out of your ability to follow me, that's okay, because it wasn't what I was going to talk about. But with her, we had to talk about how does your worksheet accommodate these two ways to do it? And it had to, it needed to. And she wasn't real clear on it. So once again, I'm more of a junior lender who could fill out worksheets and so forth, but was having trouble quite following what it was doing. So those of you who are new, if this advanced part was a little hard for you, just know that really large NOLs, even though they need to be knocked out, possible that impacts taxes. For those of you more experienced, I wouldn't throw that out in the beginning, but as soon as you do run into one where the NOL is really large, the taxes are going to change, there's your teachable moment to help them understand what they need to do as a next step. That's all I was going to cover, David. Anything else to add, or was that more than sufficient?
No, I think it was excellent. You got a little bit into today's session that we had today. I thought it was an excellent topic that kind of got in a little bit into the weeds, which we did. But I think it's an excellent teaching moment for everybody here today. And that shows that of what we actually can get into in our lenders online training.
Well, and actually that was neat today because both David and I were there, and it is a good example of how our students are able to bring their actual issues and questions into the virtual live meetings and get access to the senior trainers all the way through the training. So that's it for today. NOLs, kind of complicated, kind of not. On the screen, you see that you can ask your own questions at experts@lendersonlinetraining.com. Follow up to this question or any other question. We have a live stream schedule, but we also have Ask the Experts. And if you want to be on the emails that get those, they come out as a blog post. One a week, we answer a question like this. It goes on our blog post, sometimes becomes the topic for live stream. But these questions are coming from you and people like you. So we encourage you to follow up with a question and or go, of course, to lendersonlinetraining.com if you or anybody in your team needs that foundational training to understand tax returns, make better loan decisions by the numbers. Thanks, everybody.